Welcome to Kirk Spano's Fundamental Trends webinar, weekly webinar on Fridays on June 29th. Today we are going to talk about oil, go through some stocks, some ideas, and answer some questions. Next week we'll come firing back out. I will have published my freedom letter in the next couple of days, and I will have a series of articles over July with the title Poker Investing in 3 Weeks in the Desert. Should be a pretty neat series. I have the ability to make some phone calls now and interview professional poker players, and I'm going to try to get a few pretty interesting analogies built up for you, including why you don't trade against the traders. Very similar to why you don't play poker against the grinders. How to leverage up your money, kind of like pot odds. And there's going to be all sorts of things that we talk about, but it's a pretty good story. I kept notes on the whole trip, and I think you're going to enjoy it, and it'll help with our investing mindsets. One thing to keep in mind is that a lot of hedge funds use poker to determine who they hire and who they don't hire now. At least for their younger associates, because the investing principles that they want to use are very similar to poker playing rules, strategies, not rules, strategies. As I said before I started recording, I did pretty good on the trip. I made money at poker, which I subsequently lost at blackjack once my friends showed up. So the lesson on this trip on the life management, bankroll control management side was don't play blackjack. Broke about even on roulette, craps, and pai gow. So if you're looking for games where you can get free drinks and have fun with your friends, I'd say stick to those, because it takes a very long time to lose your money. And if you hit a number, or catch a couple pai gows, or somebody goes on a hot streak with craps, you pick up your chips and you leave. And you can go home pretty even, or even up a couple bucks. But with blackjack, man, you have to really get a hot streak, and with those continuous shufflers, and the even the shufflers aren't continuous but are 6 or 10 shoes. What you saw in the movie with those MIT kids counting cards, you really can't do anymore. So blackjack is very difficult to win, especially when you're taking advantage of the free drinks, because in blackjack you actually have to do some math and keep track of cards and vary your bets, and you can't really do that when you're drinking, and then you already have the house working against you. So note to self, don't play so much blackjack. Stick with poker. You want to have fun games, stick with the 50-50 games, which are roulette, pai gow, and craps. So I moneyed in 5 out of 11 tournaments in poker, including my first Pot Limit Omaha tournament. And what I determined is that I'm a very good amateur poker player, but when I got against the pros in the monster stack of the World Series of Poker, and I had 4 pros on my first table, it was a tough table draw. They had all had over $1 million in career earnings, and they kicked my butt. And I made 2 mistakes that I shouldn't have made, but I had probably been worn out from a deep stack tournament at the Venetian that I played for 18 of the previous 30 hours, and I forgot to do something. I forgot to bet back at people that bet at me, and that is a problem when all they do is bet at you. So I will not make that mistake again. All right, why is that important? I don't know, because it has something to do with investing, and I'll talk about that in the articles coming up in July. Today, let's talk about oil. Way back when, probably a year ago, and I've made the point several times since, I said that Saudi Arabia was going to become the global swing producer again, and that by disrupting long cycle oil projects, And in the face of still rising global demand for oil, that Saudi Arabia would once again be the swing producer, even though everybody was singing the shale, 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 drill, baby, drill song. And the reality is that even though we have the ability to drill a little bit more oil than we are now, and eventually the infrastructure will be in place to transport it, we do not have the excess reserves that Saudi Arabia has at their disposal. So, what have we seen here in the last couple of years? Demand for oil continues to slowly increase. The long cycle oil production, like deep water in particular, is permanently subdued because the end of the oil age, which is upon us, it's a slow end. It's not going to happen tomorrow, but over the next couple of decades, is going to prevent a lot of oil development in the seas, because they need to know that once they sink those billions of dollars into getting the oil, that they will generate enough barrels at a high enough price to get their money back. So when a deep water project says, hey, we're going to have break evens at $40 a barrel, well, yeah, but you still have to produce enough barrels to pay off the initial investment, which is billions of dollars usually. So, keep that in mind. Just because you get the first barrel at $40 doesn't mean that you've paid your debt back. So if you start $1 billion in the hole, how many $40 barrels do you have to produce that you're going to be able to turn around and sell for 70? The answer, a lot. So deep water drilling is going to be permanently subdued because they know that the end of the oil age is coming. They don't know how expensive they'll be able to sell the oil for between now and then. For a while, it's going to be in the 70s and 80s. But eventually, we are going to get a turnover in that curve. And that probably happens around 2030, plus or minus. But in that general range, I'll find that chart and pull it up again. Short cycle oil production, like fracking, in the United States is limited to how much more oil it can produce short and long term, hence why we aren't actually oil independent yet. We're darn close if Canada and Mexico are included. So North American oil can support the United States, but American U.S. oil cannot. We still are importing quite a bit. Sanctions on Iran, which we saw some news on this week, will disrupt global oil supply movement for at least the next 2 years. And I say for at least the next 2 years because who knows what happens after the 2020 presidential election. Who knows? But the administration, the Trump administration, as I have told you, is putting the screws to everybody who imports Iranian oil and said, hey, you need to get rid of all your Iranian oil by November, or we're going to stick it to you on the banking system. Now, will that work for everybody? No, but it will work for quite a few. And that really creates a situation that is pretty interesting to me. So you have the United States, which is trying to negotiate with China, the largest importer of oil in the world. And at the same time, the United States is telling everybody who imports oil from Iran, of which China is the largest in the world, hey, if you import oil from Iran, we're going to jam it to you on the international trade and banking system. So there is a lot of potential for conflict between the United States and China between now and November. I have said I think the trade tariff war, the trade war, will not materialize in full, even though I'm in a town where Harley Davidson is getting jammed by the Europeans in a retaliatory move. So I don't think the wall, I don't think there's going to be this big wave of trade war responses, but we're in a position now where it could happen. So if we don't resolve these trade issues in the next few months, going into November, when these Iranian oil sanctions become fully effective, you could see a lot of interesting things go down between the United States and China. Now, what I think makes the most sense for it to happen, and I'm a believer that things that make sense eventually do happen, even if they don't happen right away, is I think the United States cuts a deal with China on oil and natural gas. I think that there's some relief to China on the sanctions with regard to Iran. I think that China is asked to put some pressure on Iran, just like they were asked to put some pressure on North Korea. The problem with Iran is that the Ayatollah doesn't respond well to pressure. I don't think he's likely just to step down. Maybe we'll get lucky and he'll have some sort of nuclear death. And I don't mean by bomb. I mean, who's to say the Russians don't kill him? But, regardless of the way things go down in Iran, all these trade issues surrounding Iran and surrounding the tariffs and surrounding energy, they all have this weird web interconnectivity that is dangerous, not only for individuals, but for economies and for populations. So we really have to keep an eye on this stuff as investors, because the linchpin right now does appear the linchpin to the global economy does appear to be trade issues and oil. So we will see how this all shakes out. My belief is that we are now on the peak oil plateau. What that means is that demand and supply will be roughly in balance for a long time until demand starts to go down. Again, I believe that happens around 2030, give or take. So for the next decade or so, oil companies should do very, very well, especially the oil companies that have short cycle oil that's almost immediately profitable. And, we have some investments in that space. The reason why global oil demand and supply will remain in balance, again, it's because there is still a finite amount of economic oil, right? You can't go into the deep water and pull out $120 a barrel oil if you're only getting 70, $80 for it. So there are limitations on the amount of deep water that will come online. There's no doubt that oil is down in the ocean. It's down there. But the producers are not going to go get it if they know that in a decade or so, they might not be getting a high enough price on those barrels to make it worth their while, to repay the debt that they will incur for bringing projects online. So continue to look at companies like Total and some of the Gulf producers in the United States, the Gulf of Mexico producers, because they will be the offshore that survive and do pretty well for the next decade. But the companies that focus on the deepest water, the most expensive water, the hardest oil to get out of the ocean, that's it. They are doomed. I said they were doomed several times over the last few years. I stick by that. We are going to see another wave of bankruptcies among the deep water drillers in the next few years. Which ones will survive? I don't know. Transocean has a great fleet, but they have a lot of debt. Do they declare bankruptcy, kill the shareholders, and turn the debt holders into shareholders? I think that's a very real possibility at some point. Ensco has gone through some strategic transactions. I think they probably survive. Do they have to wipe out the shareholders first? I don't know. But some of those companies out there are going to have to wipe out the shareholders, and they won't be reorganizing. They'll just be liquidating. So, you have to take a look at both types of bankruptcies. How will they evolve? Who will they impact? Who will be the last men standing in offshore? I think right now it's too early to tell. If I had to make some bets, I would say Transocean eventually goes bankrupt, but survives with a new shareholder base, being the bondholders. Ensco could go that route. We'll see. But there's a lot of Noble there's a whole bunch of companies out there that aren't going to exist. So there will be a second wave of bankruptcies in the offshore space, probably by the early 2020s. All right. Saudi Arabia, by virtue of having 2 to 3 million barrels of excess capacity, is now the global swing producer by virtue of killing all that long cycle competition. The shale is going to continue to do well, and we're going to make a lot of money on that, probably doubles and triples. I have talked about this throughout the whole process. Gotten it almost all right. Right in here, my timing was a little off. This last bottom caught me by surprise. But from middle 2015 to early 2016, like everybody else, I got my ass handed to me. But ever since then, doubling down on a lot of my positions and accumulating oil stocks, and in the last several months, actually betting on oil from about here, have done very, very well. I know that we have investors that are up 20, 30, 40% this year. Somebody told me they're already doubled their money. They're very aggressive. So, I wouldn't think that doubling your money this year so far is indicative of a real conservative asset allocation. It's indicative of a very aggressive asset allocation, and it worked. All right. So, let me take a look at the question board before I get into the companies. Does everybody understand what I'm saying about Saudi Arabia being the swing producer? Does anybody have a question about that? Why they're the swing producer? Again, it's because they have a couple of million barrels, 2 to 3 million barrels a day that they can bring onto market. And in fact, in July, Saudi Arabia is ramping up production pretty big, which will be a new record, apparently. We'll see if they actually hit the new record, but they will be producing more to offset the surge in global demand and the disruptions from Venezuela and Iran. All right. So I wrote an article a few years ago titled, let's see here, see if we can Google freedom from OPEC. Who pops up? Oh, wow, I don't come up that high on the, well, here's one of them. I used to pop up number one. Freedom from OPEC. Spano. There you go. All kinds of freedom from OPEC. I'm not popping up there much either. The Google doesn't love me today. All right. So anyway, freedom from OPEC is getting much closer. I wrote this last summer. I originally wrote an article for MarketWatch way back in 2013 about what was going to be the combination that led to U.S. energy independence. And it is a combination of our oil, our natural gas, and development of solar, which I was listening to President Trump yesterday over at Foxconn, and he specifically talked about how solar manufacturing is coming, and it's going to come on pretty heavy, and it's going to be U.S. based. I believe that because ultimately, I drove through the desert again, as you guys know, stopped at the giant facility solar facility in Henderson, Nevada, and talked to some engineers and other people that we ran into because they were wondering why my truck was on their development. And I'll tell you, I can see every parking structure in Vegas covered with solar in the next couple of years. And I already know that there's a bunch of orders. There is no reason why cities like Phoenix and Las Vegas and across Texas and New Mexico and Arizona and California, of course, passing a law to tell people who build a house in the 2020s to throw solar on there. There's no reason why the whole southwest part of the country doesn't go solar pretty quickly. So keep an eye on that. It's going to yield massive potential profits for us. But in the meantime, we still have a lot of oil because the EVs aren't coming yet. And we're going to get a big, big jump in energy producer earnings. And that should start this quarter. So come July and August, when the oil companies start to report profits and earnings, you're going to go, oh boy, I sure wish I had bought oil stocks before this. And what's the easiest way to buy oil stocks? Bam. SPDR, S&P Oil and Gas Exploration and Production ETF, XOP. Up nicely again today. Last few days have been pretty good. Had this little consolidation period. And I'll tell you what, an interesting breakdown over here. Shaken Moneyful really turned over during this period where there was consolidation. It looks like it's just starting to work its way up. So here's what's going to happen with oil stocks. You can hear me now, believe me later, I don't care. I'm a little bit tired from Vegas still, and I don't have a lot of argument left in me. What's going to happen with oil is this. The oil stocks. We're already almost done with our oil trade on pure oil, and I'll get to that in a minute. But oil stocks, think of it this way. At $50 a barrel, they all became profitable. Started issuing more dividends, buybacks, and drilling out of cash flow. They stopped taking on debt, started paying down debt. What will that look like when their realized gain or the realized price of oil is in the 60s? And what will it look like in another quarter when that realized price of oil is approaching 70? And next year, what will it look like when their realized prices of oil are in the 70s? Right? As their hedges roll off, they do new hedges. They get, and then some of the oil they get at spot. You're going to see cash flow and earnings surge from these energy companies. The group has not taken off yet. What will happen as it starts to go up and people start to see headlines about oil profits, and as they notice that their gasoline tank takes a couple more dollars to fill, what's going to happen? They will get panic buying. So let's take a look at a spot where we had some panic buying. Look at this. Right before the financial crisis. Bam, panic buying. Crash. Gradually goes up with some panic buying here. Consolidates. Run up. Everybody thought the oil was just going to keep going to the moon. OPEC steps in, Saudi Arabia in particular, crushes long cycle oil by flooding the market with oil, pressing the price down temporarily, kills competition during this period. Oil starts to kind of act more healthy. People start picking it up. Get some mini corrections, shake some people out. And now we're here. Can we break down again? Absolutely. I think we could see price drop a little bit. But these stocks, the people have been accumulating in here, are going to go back up here. Will we get all the way to the peak? I don't know. These companies have cut their expenses so hard and become so efficient that you could see a ton of money drop to these bottom lines. So how will that impact share prices? I believe we get the panic buying. I think XOP is destined to hit 80 again. And it might go up to 120. We might see an all-time high way up here 2-3 years from now. So if you want to balance your asset allocation towards something that's going to win, you need to just buy XOP. You can cherry pick stocks, which is what I've been doing as well. But my largest position in all of my portfolios now is XOP. Why? Because it gives me a nice spread across all these companies. Some of these companies I've recommended. Centennial I talked about in one article. I've mentioned Diamondback. Cimarex was in my energy report a couple of years ago. Southwestern Energy Group, I'm not a huge fan of, but I do like Antero, which is a similar company. Apache, I just talked about here's Antero. Apache, I just talked about with subscribers. And I also wrote an article about them a few years ago. I don't know if it's out there anymore. Apache, Kirk, will the Motley Fool article even pop up anymore? Nah. Oops. You know, it's a long day coming when you're already spelling your name wrong. All right. Apache. All right, let's get this right. I don't know. Am I spelling it wrong? No, that's right. All right. So anyway, I talked about Apache years ago. They went through some transformations before the oil crisis and the oil crash, and they look like they're in pretty good shape. So go through here. A lot of good companies. Hess just sold a bunch of assets. Exxon, EOG is a darling. Noble Energy, I think, is going to do all right for a little while anyway. And Darko, Range Resources, and some of the other holdings that aren't in the top 25 I've talked about as well. Chesapeake Energy, was Chesapeake Energy in there? Chesapeake Energy is in there. They weren't, but their stock price doubled and pushed it up. Stock price doubled after I told people to buy Leaps. Here it is, 533, running into some resistance. Maybe not. How does money flow look? Are people starting to buy this one again? I think people are probably still afraid of it. A little bit of accumulation. Yeah. If you take a look at the 10-year, do a weekly chart. Look at that consolidation phase. The higher price of oil is going to pull this up. I think that Chesapeake goes to around 8. And I've said all along that I think the company's worth $15 a share after they sell off some oil assets and become a very lean natural gas producer in a few years. I think that this one is the one that you hold on to. I've got my Leaps. They're good until 2020. I can see doubling, tripling, quadrupling my money. Maybe we've already doubled our money on our Leaps with Chesapeake in 3 months. So I think that we'll see another double there as that goes up. All right, and Kana, same story. We know that this is a favorite of ours. Did a lot of accumulation in here. Rose for us, fell back. Looks like it's going to break out again. Again, their story is they have assets in the Permian, the Eagle Ford, Monterey, and Duchovny. And I say that wrong every time, but just 4 plays. They've really consolidated things. They have a ton of cash dropping to the bottom line. The return on invested equity is high. Their return on capital is high. Their return on equity is high. Everything about this company is going in the right direction. And I think it too reaches all-time highs 2-3 years out. Potential triple from here. That is why I also own Leaps on this stock. Occidental, throwing off a big dividend, even though we were buying around, we bought almost right at the bottom. We started buying in the low 60s, so that was great for us. It's in the 80s now. How high can it go? Again, I think all-time highs. I would be shocked if this stock doesn't break $100 a share. Now, for the growth investor, not that big of a story. But for the dividend growth investor, hey, this is awesome, because as they have more cash dropped to the bottom line, what are they going to do? They're going to increase their dividend. So if you own Exxon or Chevron, I have told you a number of times that those are companies that at some point are going to run into big, big trouble. And while they can go up now for at least the next year or two, they're not going to keep up with companies like Occidental and a whole bunch of others on this list for total return. It's not going to happen for them. And I will show you a chart. Let's go to the chart. Let's put in XOP, XOM, CVX, and let's normalize it for a time period. And over the last year, who's the winner? Occidental. Who's second? The group. Who's third? Chevron. Who's fourth? Exxon. That's just last year. Now, you can say, well, that's short term. It is. Let's take a look at the last 5 years. Who's the winner? Chevron. Who's next? Occidental. Then Exxon, and then the group. But what did this include? This included the crash. So let's do 3 years. Chevron is still kicking butt, but Exxon is doing well. Excuse me, Occidental is doing well. Exxon. Exxon, every story with Exxon is mediocrity. And then the group just started to come back. So let's just do 2 years. Now all of a sudden, the group is right there with Chevron. Occidental starts to rise, definitely crushing Exxon. So, finally you come back, where are we now? This is where we are now. This is the last year. I believe this is the new trend. I believe that the group will outperform Exxon and Chevron. And I believe Occidental is probably going to be right there with the group, but throwing off a big fat dividend. Hence why Occidental and XOP are my core holdings in there in the area. And then my plays with leaps to get big gains are Chesapeake and Encana. I also own a little bit of Pioneer, but not much. I think that they are a play on the Permian, doing very well. They don't have a ton of takeaway issues on current production, but they are going to have to limit their production for the next year because there is a takeaway issue in the Permian. So I think any pullbacks in Pioneer stock are worth going after, but I don't love them now, right? Because I was talking about these guys back in here. They had a run up, pulled back, go back up. I think you may get another chance to buy them in here. I could be wrong. If you already own them, make sure that they're not a giant part of your portfolio, but certainly a good core company. All right. Somebody asked me about Enbridge and Spectrum. Here's a good article. Take a read of this. I like Enbridge a lot. The solar power facility down in Henderson also had Spectra signs all over it. So understand that Enbridge is a big deal. I like Enbridge a lot. If they're not on my list officially, I'll have to add them. I'm pretty sure they are. All right, let's go to questions and keep this one a little bit short today. Are Canadian oil sands projects economic at 80 and infrastructure viable yet? Any other high-cost producers that will be newly profitable now? What about Total? All right, so existing oil sands is profitable. Well, very profitable at higher oil price realizations. The problem is they have an infrastructure problem there too. So you have to look company to company. Syncrude is having a problem right now. They're really not going to do much more development of oil sands in Canada. Interestingly, I sat next to a significant pipeline guy up in Canada who was just like, yeah, Vancouver's making decisions for the whole area, and we need to bypass them and get that pipeline to the sea so we can export oil. And so I think there is some long-term viability to the Canadian oil sands producers. I know that a couple of them are beat up, so we'll have to take a look at those going forward because we might get a good value play. Total is, very diversified. I like them. If I had to own a major, and I don't have to, but if I were going to own a major, Total would be the one. They have interest in utilities and gas and oil. They've been very good at bargain hunting for acreage and plays, and then of course the sun power. Yeah, I think the deep water drilling companies have another set of bankruptcies at some point. So people are buying those stocks right now. Eventually, I'll short those. With inverted yield curve approaching, if there is a recession on the horizon, there is a recession on the horizon. Not if, it's when. What will that do to oil stocks? Will there be a pullback in the case of recession? Yeah, there will be. 2-3 years out, right? So this oil stock trade right now is for the next 2-3 years. When the recession comes, we're going to have to sell a lot of things. Oil stocks probably be among them. And we'll see if the Fed keeps pushing us towards a recession. What's going on with the labor force and immigration and interest rates and oil, all these things work together in a really complex dance, and it's hard to figure out. So we have to find the places where we can have high confidence, try not to make hero predictions, just like making hero calls in poker, and stick with the stuff that's easy enough to understand and make a investment in. We don't want to try to make a lot of hard decisions. We want to make as many easy decisions as possible. Would you play XOP with 2020 Leafs? I've done that months ago. So, yes, the answer is yes. And I do believe they are actually fairly priced right now. So you could start buying those. Working on the triple. What does that mean, Millennial 25, working on the triple? You've tripled your money this year? If you have, fantastic. Oh, for CHK. Yeah. Yeah, we're real close to a three-bagger already. You're right. What is the political stability in Saudi Arabia? Well, they tried to assassinate the prince a while back. I talked about that. It hasn't got much press. I really don't have any idea why that is. So how of the potential assassination, and the rumors are that he actually did get shot. How that doesn't hit the press is beyond me. I mean, I understand that they have to cover the president, but there's a lot of things happening all over the world. So if your primary news sources are Fox, CNN, MSNBC, you really ought to diversify. You ought to be reading BBC. You ought to be checking out some of the foreign press, because the news that we get is so directed towards ratings, and then whichever network has their slant. It's horrible. We are not getting the real news. There's a lot of things happening around the world, so you need to diversify your news sources. If you go over to my fundamental trends page, and I'm rebuilding kirkspano.com to be a free service with things like this. Here are some of the resources I use. And I haven't used City Falcon in a while, but it's a pretty neat news aggregator. See, personalized financial news. I think this is worth registering for. I don't pay for it. I don't even remember how I sign in. I haven't used it in so long. Maybe through Twitter. Sure, let's try that. So you can personalize your news through City Falcon and get an email update every day. I like this one. So I throw this out there for you. Like I said, I don't pay for anything here. I don't even know if they have a pay service. But the news, it's a nice aggregator. And it will stick pretty much to American, but at least you can do it by subject. I have this whole list of places where I get news from. South China Morning Post. Tell you what, this and Economic Times from India are very worth reading. These are pretty important viewpoints, and they get a lot of news out there that, like I said, we're not finding in our press, which just doesn't make any sense to me. All right. Can you do a webinar once on what technicals you look for in a chart and your thought process behind it? I've actually done that before. I like the Chaikin or Chaikin ratio for money flow. To me, it's a big deal. We want to find where the divergences are and exploit those. And RSI is the super easiest thing to use. So right now we own some leaps on Antero Resources. Might sell some of them today, actually. You know, we're approaching overbought. And, we also have some August calls, so I probably have to get rid of those soon. We're closing in on the point where if you have August calls on anything, you need to be looking at taking profits on anything. The time duration's getting too short. How important is battery technology to development of adoption of solar? Very. Our battery is dropping in price and improving in storage like solar panels with cost efficiency? The answer is yes. Or will smart grid energy mix solve the fluctuations? Well, so here's the thing. Even with the smart grid, we're going to have battery storage. And the way that battery storage is probably going to look like is you're going to get facilities, sometimes utility-owned, probably mostly utility-owned, but also you're going to get microgrids. Those are becoming very important. And I think municipalities are going to start to have their own energy storage and energy generation solutions. So I live in a community which, they won't do it soon, but they do have some progressive nature to them. They at least make good financial decisions where I live, in a suburb that I live in. And I can see a lot of communities, suburban communities, that have a little bit of land, building a warehouse somewhere, putting batteries in it, and on top and around having solar arrays. And then using that energy to power all of the municipal buildings and the streets and things like that. So that's coming. There's going to be a very interesting mix of projects, and municipalities, companies, and people are going to have various choices and options that they can make. So I do think that once solar becomes a bigger part of the mix, that's going to be very good for our pocketbooks. But the build out, of course, costs money. Yeah, I like Enbridge and Kinder Morgan. I think Kinder Morgan is priced better right now, but Enbridge is a great company. So owning them together, I think, is outstanding. Somebody is asking about overstock in the blockchain. That's not oil, so we won't touch on it today, but we will get to it in a future call. We're going to do a lot of smart everything stuff over the summer. I don't have trailing stops on everything, but I do use trailing stops. I like trailing stops at around 12 to 15% on a stock, 6 or 7% on an ETF, and you have to be careful with those. Your very favorite positions, I generally don't. Like an XOP, I really wouldn't put a trailing stop on that. But the stocks on Encana, on Chesapeake, Occidental even, I would use a trailing stop because you have, individual company risk. For XOP to hit the bricks and really slide down and have it be a permanent and more dangerous thing, you probably get more warning signs because it encompasses 75 companies. So with the ETFs, I mean, if you're trading international ETFs, for sure, use a trailing stop. And sector ETFs, same argument, but I'm so confident in XOP that I'm not really using one there. I could, I just don't. If it makes you sleep better at night, go ahead. Yes, I have thoughts on Micron, but not today. When will it be time to sell USOU? I have said that before. Is as oil approaches 80. Somebody asked about this. As oil approaches 80, I'm going to scale out. So maybe I sell a little at when oil hits 77. WTI is 77. I think it's approaching 74 today. So we're getting close, right? Scale out as your target price for oil gets closer. Thoughts on the bank stress test and the financials? Yes, I have some. Not today. Any other oil, energy questions? No? Well, all right. It's 90 degrees here. Are you buying more calls? I'm loaded up on calls. However, and I wouldn't really be buying calls on USO anymore. I think the place to be getting your accumulation for pricing reasons is XOP. Let's take a look at USO and XOP. Normalize them. Price of oil has done better in the last year than the price of stocks. Higher oil prices means the stocks will do better. The companies will do better. More earnings, right? This gap will close. Eventually, this will turn over and jitterbug sideways, and this will cross up higher. So XOP is what you want to accumulate now. ECA leaps. I own the January 2020 10s and 12s and the January 2019 10s. You can ignore those. You don't need to buy those no more. But the 2020s, I think you can buy the 10s and 12s. The 10s on dips, the 12s probably right now. And those are in the money. I like being in the money on those because it reduces my risk. If you want to speculate on this going to 20, then take a look at a leap that maybe is a 15, right? Go a little out of the money. It raises your risk, but it lowers your price, right? It lowers your price on the leap. So you could buy the January 2020 $15 leap in Encana probably. Maybe the 14, maybe the 16. I haven't looked at the pricing. And that would probably be a good way to go. I don't know if 8081 is the top on WTI. If the disruptions to supply really are worse, we could very temporarily see oil go to 100-ish, 120 maybe even. But Saudi Arabia is going to pump more oil. They're going to pump it as needed, they said. I believe them. Russia has some capacity too. Somebody asks about the 2019 ECA leaps. You're up 160%. Good for you. Good for you. I'm glad some people buy when I talk. That just brings me to something. I'm not trying to convince anybody to buy anything. I'm just telling you what I do and what I think. And then you have to decide if it fits in for you. And I want you to go and do some of the research on your own. I know there's a lot of folks out there that are just going to say, hey, I'm going to buy it because Kirk is buying it. I really don't want you to do it that way. I really want you to take the time, at least read the investor presentations of the companies that you're getting into, even if you don't have the time or the skills to read a 10K. But read the corporate presentations on their investor websites and that'll at least help you out. I would probably, I actually am going to start scaling out of the 2019s over the summer. I will let folks know what am I doing, what I am doing, and when I'm doing it. All right. It looks like we are done. That was about 50 minutes. That's wonderful. Again, thank you for being patient with me while I experimented out in Las Vegas. You know, part of that trip was to find out if I wanted to live there. And I think the answer is no. It's just too darn hot in the summer. And one of the reasons I would move is to get seafood. And in my head, you know, the wheels are spinning right now. I think for me, Costa Rica is a very real possibility for part of the year. I think Florida could be too. I want to be somewhere where I can get fresh fish and seafood, and you really can't get in Vegas without paying an arm and a leg. Plus, you know, eventually the desert Southwest is going to have to come to grips with their water issues. And I don't want to be there for that, because the answer is going to be that somebody's going to have to pay for water pipelines in from desalination plants. And that's going to require a lot of money. Ultimately, taxes will go up in Nevada because the rich guys won't pay for it all. You know, the casino owners won't pay for it all. So, to me, you know, yeah, come to the West Coast. I tell you what, California is interesting to me. If they ever have a nice fat real estate crash, you probably see me there. I like this whole San Diego. Yeah, Portland. Oh, yeah. I've been to Portland. It's weird, right? I know they keep it weird. They keep it weird. I like Portland. I like Seattle too. I thought Seattle was a wonderful city, especially over the summer. So I don't know. I think I'm destined for two homes. I don't know where they're going to be. I think Wisconsin will stay one of them, but it'll be the lesser home. It'll be the place that I'm at for 12 or 15 or 16 weeks, you know, 3 or 4 months a year. Still going to do my East Coast trips every autumn. Would like to travel to warm places over the winter. So I don't know. We'll see. I will be moving around a lot over the next decade. Maybe I'll end up having 4 places. I don't really know. I have to figure it out. I know somebody who is retired and has a condo, and then he Airbnbs different places, like month to month. He'll go to Italy for a month. He'll go to Japan for a month. He'll go to Costa Rica for a month, and he's doing this with, you know, for 4 or 5 months a year. That's interesting to me. So if I could find a condo that I liked, you know, I could be an Airbnb guy. We'll see. Portland's not that weird. We have intel. Okay, very good. All right, thank you for listening, and continue to send questions. But I tell you what, if you don't own XOP as a significant part of your portfolio, that is the takeaway today. Buy XOP. The price of oil is going to stay firm. Supply and demand are going to be in balance, and that's going to last a while. So these companies are going to become very profitable over the next several quarters and couple of years. We'll worry about the recession when we can start to see it. All right, peace out.